Hello and welcome to the Ditto educational series that will provide you with the skills you need to become a Forex trader. Today we are going to be looking at technical indicators specifically, as well as their practical application. Technical indicators in the Forex market are used for measuring or forecasting, as well as trend following, tracking price oscillation, measuring volatility, and finding support and resistance levels. By grouping indicators based on what they do at a base level, we can accelerate the learning process and gain an overall understanding of them in a short-term span of time. Upon first discovering and reviewing the library of available indicators that can be applied to your charts, you may be generally overwhelmed by the sheer amount that are available. The jargon and abbreviations alone surrounding some of the names is enough to confuse most people. Attempting to learn all of these available indicators seemingly was an impossible task until you realize one thing. A lot of these indicators are very similar to each other, and if you understand the primary groups that certain indicators fall into, then you can take a understand one, understand all outlook within the respective groups. Let's now take a look at the groups of technical indicators and outline what they basically do. Trend following. Trend following indicators were created to help traders identify markets that are actively trending in any particular direction. These indicators can help us point out the overall direction of a trend and can inform us by using a correlation of data if trend actually exists. Moving averages. Moving averages, or MA for short, are very popular and strategies are developed surrounding them. This technical tool averages a currency pair's price over a period of time. The smoothing effect this has on the chart helps give a clear indication on what direction the pair is moving in. There are a variety of moving averages to choose from and parameters to adjust. Simple moving averages and exponential moving averages are by far the most widely used. Ichimoku. Ichimoku is a very complicated looking trend assistant that is actually much simpler to utilize than it initially appears. The Ichimoku tool is a Japanese indicator and was created to be a standalone indicator that shows current trends. We never just use one indication to trade, but this indicator encompasses support resistance levels and indicates when a trend is likely to be reversed. The word Ichimoku loosely means one glance, and the tool is meant to be a quick way to see how price is behaving on a chart. ADX. The average directional is a different breed of trend analyzer. It doesn't tell you whether price is trending up or down as conventional trend indicators do. However, it does distinguish between whether a pair is ranging or trending. This makes it the perfect filter for either range trading or trend trading strategies by making sure you are trading based on current market conditions. Oscillators. Oscillators give us a picture of how momentum is developing within a specific currency pair. When price moves higher, oscillators will reflect this by moving higher, and when price moves lower, the oscillators will move lower. Whenever oscillators reach the extreme levels, then it might be time to look for price to revert to the mean. Although when an oscillator reaches its overbought or oversold levels, that doesn't mean we should make a decision on whether to buy or sell just based on that piece of evidence, as oscillators can remain at extreme levels for extended periods of time. RSI. The Relative Strength Index is probably the most popular oscillator used in technical analysis. Simply put, it measures the ratio between the average gain and the average loss over the last 14 periods. The RSI has a range between 0 and 100 and is considered overbought when above 70 and oversold when below 30. Traders will look to sell when 70 is crossed from above and look to buy when 30 is crossed from below. Again, this is not a valid standalone tool for entry. Stochastics. Stochastics offer us a different way to calculate price oscillations by tracking how far the current market price is from the lowest low of the last number of periods defined by you. The distance is then divided by the difference between the high and low price during the same number of periods. The stochastics will display two lines moving between 0 and 100 with overbought and oversold levels at 80 and 20. Traders often wait for the two lines to cross each other while in overbought or oversold territory, and additionally they can look for divergence between the stochastic and the actual price for a signal to enter a trade. CCI. Another non-traditional oscillator is the Commodity Channel Index. It's different to many oscillators because there is no limit to how high or low it can go. It uses 0 as a center line with overbought and oversold levels starting at plus 100 and minus 100. Traders look to sell below plus 100 and buy breaks above minus 100. MACD. The Moving Average Convergence Divergence Indicator tracks the difference between the two EMA lines. Those lines are 12 and 26. The difference between the two EMAs is then drawn on a subchart called the MACD line. It also has a 9 EMA drawn directly on top of it called a single line. Buying opportunities present themselves when the MACD crosses the line above the signal line, and selling opportunities arise when the MACD line crosses below the signal line as seen. Traders may also look for opportunities to trade divergence between the MACD and price. Volatility. Volatility basically measures how large the upswings or downswings are within the currency pair. When a currency price fluctuates dramatically in one direction or another, it is said to have high volatility. A currency pair that has steady or consistent movement is said to have low volatility. It's important to note how volatility in currency pairs is before opening any trades, as we don't want to be surprised by spikes in the market. Bollinger Bands. Bollinger Bands display 3 lines directly onto your price chart. The middle band is a 20-period simple moving average with an upper and lower band that are drawn 2 standard deviations above and below the 20 MA. The more volatile the market conditions are, the wider the outer bands will become. The less volatile they are, the smaller they will become. The most common uses for Bollinger Bands are usually looking for trade entries bouncing off an outer band in the direction of an overall trend. ATR. The average true range tells us the average distance between the high and low price of the last preset number of bars. Typically this is set to 14. This indicator is presented in pips, where the higher the ATR gets, the more volatile the pair, and vice versa. This tool is perfect for measuring volatility and can help us choose our stop loss prices. Support, resistance, pivot points. Pivot points are one of the most widely used indicators covering markets including commodities, equities, and forex. They are comprised using a formula of high, low, and close prices for the previous period. There is a central pivot line and subsequent support lines and resistance lines surrounding it. We can use these lines as potential support and resistance levels, as price might have a difficult time breaking through the indicated prices. Donchian channels. Donchian channels are similar to Bollinger Bands and have lines above and below recent price action. They reflect the high and low prices over a chosen period of time. These lines can then act as support or resistance if price comes into contact with them again. A common use for Donchian channels is trading the break of a price in the direction of the overall trend. We discussed some strategy surrounding the DNC indicator in our video of how to become a full-time trader. Hopefully you have enjoyed our discussion today, ladies and gentlemen, and now have a greater understanding of these indicators and the groups that they fall into. Please sit back and contemplate what you have learned today, and remember, contemplation is the key to learning.
Thank you for watching the video. If you enjoyed our educational sessions, then please like and subscribe.